Fallout in the financial services sector has intensified following the second round of public hearings at the Royal Commission into Misconduct in the banking, superannuation and financial services industry. AMP came out swinging in its response to the Royal Commission, arguing that fees for no service was old news and its misleading representations to ASIC were overstated. However, investors were unimpressed by AMP's historical conduct and response to the revelations. When proxy votes became known 2 days before their annual general meeting on the 10th of May 2018, 3 board members were forced to resign. These resignations follow the departure of CEO Craig Mellor, Chair Catherine Brenner, and in-house counsel Brian Salter. The Chief Risk Officer for Advice, Paddy Bagri, has also resigned. This was not enough to stop the largest shareholder protest vote in Australian major corporate history. More than 61% of votes were against the company's remuneration report. A second strike of more than 25% next year would force all the board out. AMP is also fighting class actions by shareholders who have seen the value of their shares plummet. Shares have fallen about 25% since the beginning of the second hearing, wiping out more than $2 billion from the company's value. AMP said it would vigorously defend against the claims. While numerous commentators expect Commissioner Kenneth Hayne to recommend an end to the vertically integrated model, market forces appear to be achieving that result already. ANZ announced it will stop paying bonuses to financial advisors for selling products. It has also exited from most of its wealth advisory and insurance business. Following suit, NAB is exiting wealth management with the sale of MLC, and CBA has undertaken a study to float Colonial First State Asset Management. NAB Chief Executive Andrew Thorburn said that the sale of MLC has long been in the works and the timing was not a result of the Royal Commission. The Royal Commission's interim report is due no later than 30th of September, though Federal Treasurer Scott Morrison has stated he is willing to give Commissioner Kenneth Haynes more time if needed. APRA's report into CBA's governance, culture and accountability was described as damning by Federal Treasurer Scott Morrison. The report concluded that the bank's financial success had made it complacent, reactive to risks and insular. Further, it did not learn from past mistakes and that an overly collegial environment curtailed constructive criticism, timely decision-making and a focus on outcomes. The Treasurer said the report should be required reading not only for every financial institution in the country, but for every single board. APRA Chair Wayne Byers said given the nature of the issues identified in the report, all regulated financial institutions will benefit from conducting a self-assessment to gauge whether similar issues might exist in their institutions. To address the issues, APRA recommended that CBA focused on 5 key lever areas: more rigorous board and executive committee level governance of non-financial risks, exacting accountability standards reinforced by remuneration practices, a substantial upgrading of the authority and capability of the operational risk management and compliance functions, injection into CBA's DNA of should we questions in relation to all dealings with and decisions on customers, and cultural change that moves the dial from reactive and complacent to empowered, challenging and striving for best practice in risk identification and remediation. The report was produced because of a number of incidents that damaged the bank's reputation and public standing. CBA's accountability failures have cost the bank's bottom line. Most recently, on the 9th of May 2018, CBA announced an in-principle agreement with ASIC to settle legal proceedings in relation to the rigging of the bank bill swap rate. Assuming federal court approval, the settlement will cost CBA $25 million. CBA will acknowledge that it attempted to engage in unconscionable conduct in breach of the ASIC Act in the course of trading on the bank bill swap rate market in Australia on 5 occasions between February and June 2012. Adding to Chief Executive Matt Comyn's difficulties is the departure of another executive, Chief Financial Officer Rob Jasudason. 6 executives have left since Austrac filed proceedings against the bank in August 2017 for breaches to the Anti-Money Laundering and Counter-Terrorism Financing Act. The Turnbull government has accepted the majority of the recommendations from the Senate White-Collar Crime Report. Specifically, the government has agreed to increase the availability of infringement notices, to increase civil penalties and allow the maximum civil penalty to be set by a multiple of benefit gained or loss avoided, and to allow for the disgorgement of profits in civil proceedings. The Senate inquiry into white-collar crime was established in 2015 to address inconsistencies and inadequacies of current criminal, civil and administrative penalties for corporate and financial misconduct. The number of members an SMSF can have will be increased from 4 to 6, and rolling funds into the vehicle will be made easier in upcoming changes from the government. Minister for Revenue and Financial Services Kelly O'Dwyer said the changes will allow for greater flexibility and, given the growth in the sector to date, will ensure SMSFs remain compelling retirement savings vehicles into the future. SuperStream will also be extended to include SMSF rollovers, allowing SMSF members to initiate and receive rollovers electronically between an APRA fund and their SMSF. O'Dwyer has asked the ATO to work with industry to design and implement the reform, which is expected to commence from the 1st of July 2019. The RBA's outlook on growth is too optimistic, according to AMP Chief Economist Shane Oliver. In its 2nd of May 2018 statement, the RBA said it expected growth to average slightly above 3% in 2018 and 2019. However, while Oliver agrees a number of factors will keep the economy growing, such as booming infrastructure investment, he expects other factors will dampen the increase. Specifically, housing construction is slowing and consumer spending is constrained with downside risks around slow wage growth, high debt levels and falling house prices in Sydney and Melbourne. Oliver predicts growth will be between 2.5 and 3%. Australia's central bank has not changed interest rates for 19 months, with the rate still at 1.5%. An increase has been even longer in coming. The last raise occurred on the 3rd of November 2010. The federal budget was generally welcomed by economists as it contained a small boost for households and keeps the budget on track for a surplus. According to AMP Chief Economist Shane Oliver, the main risk is that the revenue boost seen this year is not sustained and the budget continues to have relatively optimistic assumptions regarding revenue growth. Key budget measures include income tax cuts from July for low to middle income earners of up to $10 a week, which is mainly achieved by lifting the low income tax offset and raising the $87,000 tax threshold to $90,000. A plan for broader tax cuts commencing in 2022, which from 2024 includes removing the 37% tax bracket and having the 32.5% tax bracket go all the way up to $200,000. Dropping the planned 0.5% Medicare levy increase, ongoing commitment to cut the corporate tax rate to 25% for large companies by 2026-27, extension of the small business instant asset write-off, increased spending on home aged care, various concessions for older Australians related to superannuation contributions and work tests, more hospital funding, and new products listed on the Pharmaceutical Benefit Scheme, and an extra $25 billion in infrastructure spending, including the Melbourne Rail Link, Bruce Highway, Gold Coast Brisbane M1, road and railway in Western Australia, and North-South Corridor in South Australia. 6 associations have banded together to form the Alliance for a Fairer Retirement System in response to Labor's proposed changes to franking credits. The Alliance's self-described aim is to explore options to fix problems with the existing superannuation taxation, age pension means testing, and broader retirement income systems. The 6 associations are the Australian Shareholders Association, Australian Listed Investment Companies Association, National Seniors Australia, SMSF Association, Self-Managed Independent Superannuation Funds Association, and Stockbrokers and Financial Advisors Association.